Hello traders. In this video, I want to talk about candlestick patterns, how to properly use the price chart itself to find good entry points for trading and for making profits in trading. Because many beginners, when they try to start their way in trading, immediately rush to some strategies of technical analysis, to some indicators, completely cover the screen with all kinds of readings, moving average indicators and so on. And it all prevents them from actually analyzing the price. After all, a chart gives us no less information than any other indicator, and in fact, even more. By looking at a chart of asset movements, we can see at what point there were more sellers, at what point there were more buyers, what the trading volume was, what the volatility was, at what prices it is profitable for someone to buy, at what prices it is profitable for someone to sell, and so on. In fact, the chart itself gives us a lot of information about the market, and it is very important to use it. And the easiest way to use chart readings is candlestick patterns. This is a combination of several candlesticks, which tell us about some state of the market, and even without deep diving into some data analysis, the number of transactions and so on, we can see what the mood of the market is now by the usual candlestick patterns. Let's look at the first one first, and then I'll go into more detail about how candlestick patterns should be used in principle. So, the first model I want to talk about is called the absorption model. It looks like this roughly. This is when we have a chart movement in some direction, such as down. The final candle of the previous trend appears, and the next candle, it is a different color and completely covers the last candle of the previous chart. This is a reversal engulfment pattern. If a figure like this appears, it indicates that an upward signal is coming soon. If you look at the reverse example of the absorption model, for example, here it is. We have an upward movement, the final candle. Here it is green, and there is a red body that is larger than the body of the green candle. This is again an engulfment pattern that tells us a bounce to the downside. There's really no magic here. Just because two candles are that size or spaced apart, the market doesn't reverse just from that. In fact, there's a clear market logic here. In particular, we have a trend. We have a situation where there are more sellers than buyers. We have a surplus in the market and the price is dropping from that. But we get to some point, in this case, the $94,000 mark for Bitcoin, which by the way, is a round level at which someone's pending orders are likely standing. It's already very favorable for someone to buy here at this price. And at this moment, what happens is that literally on the next candle, on the next time frame, we have so many buyers that they not only stop the falling trend, but also overlap the result of the last session. This means that at this moment, there are many buyers who are ready to make deals, while sellers who have been in the trend for a long time, on the contrary, will prefer to fix their profits. And this is where we may very well have a rebound starting. So I have already given two examples of the takeover model. Here's the first one. For example, the engulfment pattern, when we have a falling price, a green candle appears, which is bigger than the previous red candle. And this for us, according to the engulfment pattern, is a signal for an uptrade. The absorption model is backward looking. The same absorption pattern, we have a long falling trend, a red candle, then a green candle appears, which is bigger in body than the red one. This is an upward signal for us. And I've already told you about this one specifically too, that green candle, then a red candle that's bigger than the previous one, and that again gives us a short-term down signal. Now let's talk about the rules of using candlestick patterns. Not only the engulfment pattern, but any other candlestick patterns. There are some very important rules here. First, you will have candlestick patterns quite often, and some of them will be inaccurate. Even here on the chart, we can have an unsuccessful engulfment pattern. For example, we can consider this one as an engulfment pattern. This is a point we can consider as well. This is the point at which we can consider the absorption pattern. We have a trend, we have the red candle last, the green candle overlaps it, but actually the trend continues onward. Inaccurate candlestick pattern signals will also abound, simply because the same pattern may randomly appear as you normally use it. That's why I always recommend candlestick patterns to double check with other tools. For example, you can use fundamental analysis, whether some news has actually come out or some events have come up that suggest a future price reversal. Or you can use the usual price action, for example, add resistance support levels, if, as in this case, a reversal pattern hits a support level. This is an additional confirmation of the signal. And if there are other instruments besides the candlestick pattern that confirm the signal, then we use this entry point and use it. For example, since we're talking about reversal patterns that predict a chart reversal, for example, we might use indicators that also predict a trend reversal. For example, stochastic. Let's check our stochastic entry points. For example, shall we? So we get here, we have an engulfment pattern, both stochastics lines in the oversold zone. We confirm this signal and get a good profit on it. Next, where did we have more absorption patterns? Let's double check them. Let's say this is the absorption model we were talking about. Here we have, again, we have a red candle, we have a green candle. The stochastic was also in the oversold zone and it enters the blue zone. This is also a signal for an uptrade. You can use any other indicators you want. Bollinger Bands, such as parabolic, or some other indicators that also predict bounce and filter signals by candlestick patterns. So this was the first candlestick pattern we looked at, the engulfment pattern. Let's move on to the second one. The second model I want to talk about is the failure model, or the rebound model. It goes by different names. What is it? If we see candles on the chart that have a body much smaller than the tail, we see some very long tails, such as in this case where we have two candles at once with a small body and with long tails. This also tells us of a possible market bounce in the opposite direction. How are these tails created? I mean, we have some chart movement, for example, here in this case, growth, right? The graph goes up, 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 and up. To some point it reaches and then it bounces back sharply. What does that mean? What that means is that here, specifically in this area, we've gotten salespeople. We've gotten volume of salespeople. We can also, as a failure model, use this fork here. Right here we have two candles and their tails are about the same as the body. We also had an upward movement here and somewhere it met resistance, which may well push the chart back because this tail shows that price has risen and come back up. This means that specifically at this point, sellers have the strength to push the chart back. We can consider the same thing right here. And the same thing we can consider right here. We have a long tail in relation to a small body here. By the way, this is when we can use the failure model too, small body and long tail. So it's very important to note here that a failure pattern is not any particular candle, not any particular types of candles. This is generally a situation where you have a very, very long tail after a previous trend. It can look like a pint bar. We have already looked at the pint bar separately when a small body and tail towards the trend. You have maybe a situation like this, where you have several candles at once, where several times in a row the chart tried to fall, and all three times it met support. After that it rose. You can have so-called pincers or forks when you have two candles with two tails in a row. It is important to understand the very essence that if you have a long tail after some directional movement, it means that at this moment there's resistance or support, which can lead to a rebound, and therefore we consider the failure pattern as a reversal pattern. Again, I suggest filtering its readings, such as through stochastics or RSI or other tools. Here I want to talk about the second rule of candlestick patterns. The second rule states that the higher you set your time frame, the stronger your signal will be read. That is, the smaller the time frame. For example, on a time frame of 1 minute, you will very often have new candles, very often new signals, but most of them will be unsuccessful because there is just a lot of market noise. Candlesticks appear too often, and these movements have little effect on the chart. And vice versa, the larger time frame you set, for example, 1 hour or 4 hours, or 1 day, the more accurate your signals will be. Each candle will show data for 1 hour or 1 day. And so, the stronger and longer lasting will be the signal you see on the chart. Let's now talk about the third candlestick pattern that I want to talk about in this video. This pattern is called candle clamping or candle fading. It is quite rare and only occurs after prolonged trends. But this will be the very first signal that you need to either close your position. For example, if you traded down in this section of the chart, the candlestick squeeze would be the first signal for you to lock in profits. Conversely, if you are looking for a bounce, squeezing candles will show you that it may be soon enough that the market will either stop or move to the upside. What does candle squeezing look like? If the size of candles decreases over time, it means that the momentum of this trend has been lost. The main strength of this trend has been lost. And soon, the balance between sellers and buyers will even out, if not move to a correction. For example, we see one long candle, a second long candle, and a third long candle. There's a smaller candle here. Here again, it's more or less big, and then small, small, small. When you see a series of decreasing candles, or a series of several very small candles, it means that the momentum in this trend has been lost, and we are at least in for a correction in the near future. A reversal is quite possible. It is possible that the trend will continue after the correction. But at this point, you can either lock in profit and then look for a new entry point, or move to a reverse position, because we do not know whether the trend will continue or not, but we definitely see that it is already fading, that the trend is losing its strength. Less clearly, but we can also see with this short-term small uptrend, right here. We can say this is a small trend, at least this is what we can call a short-term trend, and again, we see the same pattern here. We have a long candle. Long, smaller, smaller, smaller. There's an anomaly here, a price spike. But again, the candle is smaller, even smaller, even smaller, even smaller, even smaller. This means that the momentum, which was at this point, has been lost by now, and we are waiting for a correction. And we can see from the chart that what's next for us is actually a whole trend reversal. Why is it important to know candlestick patterns? Yes, candlestick patterns are not applicable as a separate tool. They give a lot of inaccurate signals, but as a supplement for some indicators, as a supplement for some strategies. Candlestick patterns can additionally filter signals and give you new entry points. And in general, it is always useful to see such patterns on the chart, because perhaps they will protect you from a bad position, so that you do not open a position against a candlestick pattern, and so on. And these 3 candlestick patterns, which I described in this video, give very good results and are very well applicable in real trading. Share in the comments which candlestick patterns you already use and which ones are new to you, and see you in new videos.